might you go about financing a long-term care event? Well, here to talk with me about this is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
Pleasure to have you here. Now, I think the best place to start perhaps is with a little bit of background about what a long-term care event is exactly.
Okay. Yeah. Long-term care event, there's two types that can trigger coverage by long-term care insurance. First one is inability to perform what are called activities of daily living, sometimes referred to as ADLs. Second type is a severe cognitive impairment. And with both types, they require medical necessity or certification by a doctor that long-term care is necessary. So activities of daily living, there's six types. These are your basic tasks that a person needs to be able to do to live independently. And they include bathing, dressing, transferring, eating, toileting, and continence. And you just need to be able to perform that you are, unable to perform at least two of the ADLs in order to qualify for coverage under a tax qualified long-term care insurance policy. Second type that could get you qualification is a severe cognitive impairment or dementia, with Alzheimer's disease being the most common cause of dementia. It accounts for 60% to 80% of dementia cases.
Right. So the other part about long-term care is that many folks are unfamiliar with the costs of such care. Talk more about that.
Yeah, that's an important subject because there's I don't want to say it's a misnomer, but a lot of people think that they can self-fund for long-term care, which can be quite challenging, if not impractical to do in most cases, given the potential cost of a long-term care event. And I found that even for those of substantial means, a sizable out-of-pocket long-term care expense can really put a dent in their ability to carry out their retirement income plan and do the things that they planned on doing, especially if they have to pay for the care with taxable retirement plan assets.
Right.
So as far as the cost, a good place to go for that, a good resource is Genworth. They have an annual cost of care survey. And according to their 2021 survey, the cost of long-term care ranged from 54,000 to about 108,000, depending upon the type of care and location. And they always cite a median national cost of long-term care, which obviously that's going to vary depending upon where you're located. And this includes homemaker services and home health aid. And according to their 2021 survey, the median cost was $60,000. And to give it some point of reference, that represented an increase of about 11 to 12% over what it was in 2020.
So a few years ago, there was really only one type of long-term care insurance policy, and now we have at least two solutions to consider.
There's two solutions. Both of them are subject to an elimination period. Sometimes you could refer to this as a deductible. Basically, it's the number of days that you need to require long-term care before your long-term care insurance policy will kick in. And the elimination period generally ranges from 0 to 180 days. 90 days is pretty common. And there's a correlation between the elimination period and the premiums. The longer the elimination period, the lower the premiums are going to be. So, as you mentioned, Bob, there's two types of long-term care insurance, traditional and hybrid policies. The traditional, which I always also refer to as standalone long-term care insurance, can be a good solution for people that can afford the premiums not only today, but over the long run, because long-term care policies, the standalone policies, have a tradition, if you will, of increasing their premiums, unlike other types of insurance which have annual premium increases. The long-term care premiums generally won't increase for several years. However, when they do, they're going to be substantial increases. So the lesson is you got to be prepared to commit to payment of the premiums for your lifetime, and you have to have the ability, obviously, to pay those premiums even when you're retired. The second type of policy is what's referred to as a hybrid policy, whereby there's two types of insurance bundled into one product. One type is, obviously long-term care, and it gets combined with either life insurance or an annuity. In the life insurance version, it either links the life insurance policy with a long-term care policy or includes a long-term care rider on a life insurance policy. The type that links the long-term care benefit with the life insurance policy is often referred to as a linked benefit insurance policy. And then you have your long-term care annuities, which are simply deferred annuities with a long-term care rider. And so the long-term care benefits that are paid by a hybrid policy, no matter what type of hybrid policy it is, that's going to reduce any other benefits that would be available with the life insurance version. It would reduce the death benefit. With the annuity version, it would reduce both a potential death benefit as well as annuity benefits.
Hmm.
And so why do people, go for these hybrid policies? Basically, it's for people that can afford a sizable premium, because you're only going to pay one premium up front. And the reason that, people who can afford to do that, the reason they like to do that is because it avoids what's referred to as the use it or lose it phenomenon that you have with the traditional insurance version of long-term care, the standalone policies for the traditional policies, whereby if you don't use the benefits, you're going to pay premiums and not get anything in return. So those are your two versions of long-term care insurance.
So there's another way to perhaps pay for long-term care that people may not be familiar with. You refer to it as financing long-term care for 10 years.
Yeah, it's called a limited pay long-term care insurance policy, and it employs the traditional long-term care policy. However, and a lot of people don't know about it, that this type of policy is even available, but it gives you the ability to, instead of committing to this lifetime situation where you're going to pay premiums forever or until you have a claim, one or the other, this limits the premium payment period. And as you were alluding to, Bob, it generally works in such a way that it's a 10-year payment period is the most common form of these limited pay long-term care insurance policies. And some of the policies, and I recommend looking at this closely, they have a rate guarantee built into it so that your 10-year payment, you'll pay the same premium for 10 years if there is the rate guarantee. If not, the premium during those 10 years could increase. So you have to be careful and ask that question, if you're considering a 10-year pay. And so, once again, the limited pay policies remove the lifetime commitment, and they also avoid not just the lifetime commitment, but as we were saying before, when you have the traditional policies where you're paying every year, the the increases are unpredictable and they can be quite sizable. So, and some people are hesitant about going for these 10-year pay policies because, as you can imagine, they're not cheap. They're, nowhere close to the hybrid premiums. However, generally speaking, the premiums for the 10 years are going to be about 2.5 times what you would pay for a traditional long-term care policy.
Hmm. So we've talked a little bit about the cost. There are a lot of benefits that come with all types of these long-term care policies. Is that right?
Yeah, that's correct. And like with any insurance, you wanna the cost can be for long-term care, a big factor in decision. However, the important thing with all insurance, whether it's life insurance, disability insurance, long-term care insurance, is to look at the purpose of it. What are the benefits? And one of the key things with long-term care insurance is the benefits are tax-free. So not only are you not using assets, you're not worrying about, okay, what types of assets will I have to dig into if I don't have long-term care insurance? Are they taxable assets? Are they tax deferred? Are they tax-free? Your long-term care insurance benefits are all going to be tax-free. And also, then you don't have to you won't disrupt your retirement plan with an unplanned long-term care event. And also I think is one of the most important factors is looking at the fact who's going to provide the care. If you have a long-term care policy, you're going to have professional care provided to you automatically. In most situations where you don't have long-term care insurance, care is provided by family members, which is problematic in 9 times out of 10, basically. Most situations, that's going to be a problem because it's going to not only disrupt the family member's life who's providing the care, the family member may not be physically able to provide the care. It may negatively impact their health and well-being. And then the other factor to consider, to the extent that the care is provided by you have siblings involved, and typically one a brother or sister is going to provide the care. There can be conflict with the other ones who aren't putting in the hours and towards that end. So just long-term care insurance simplifies that. It takes all those different problems out of the equation.
Hmm. Yeah, it's the question of what price, peace of mind, I think, right?
Exactly. Yep.
So, Robert, we've covered a lot of ground. Anything that we missed or anything that just bears reemphasizing?
Yeah, I would just want to say that when you're considering long-term care insurance, and in particular traditional long-term care insurance, always remember to inquire about these limited pay long-term care insurance policies, so that you can look at a potential situation where you can limit your premium payments to 10 years versus paying for the rest of your life.
Well, Robert, I want to thank you as always for sharing your knowledge and wisdom with our readers and viewers. It's so greatly appreciated. Thank you.
Thank you, Bob.